India stands as a titan in the global rice market. For decades, our farmers have toiled to ensure our granaries are full. This has made us a food-secure nation. It has also made India the world's largest rice exporter. The year 2025 to 2026 finds the industry at a critical juncture. We are not just feeding ourselves, but a significant portion of the world. Yet, this success has brought with it a peculiar problem. The very abundance that defines our strength is now posing one of our biggest challenges. We have produced so much rice that our warehouses are overflowing. This situation, a veritable mountain of grain, forces us to ask a difficult question. Is this surplus a blessing or a burden? It is a complex issue with no simple answers, affecting everyone from the small farmer in Punjab to the government official in New Delhi. The problem starts with procurement. The government buys massive quantities of rice from farmers at a minimum support price, or MSP. This policy is designed to protect farmers from price crashes and ensure their livelihood. While noble in its intent, it has led to procurement far exceeding the needs of the public distribution system, or PDS. The Food Corporation of India, FCI, now sits on colossal stockpiles of rice. As of our current date, October 4th, 2025, these stocks are well above the required buffer norms. This surplus grain must be stored in warehouses where it is vulnerable to pests, spoilage, and quality degradation over time. The longer it sits, the more its value diminishes, creating a ticking clock for policymakers. Managing these enormous stockpiles is an expensive affair for the government. Think of the costs involved. There is the initial cost of buying the rice at MSP. Then comes the cost of gunny bags, transportation from mandis to warehouses, and loading and unloading charges. On top of that, there are recurring expenses like warehouse rent, security, and chemical treatments to prevent spoilage. The interest paid on the capital locked up in these stocks, known as carrying cost, adds another significant layer to the financial burden. This entire exercise drains a substantial amount from the national exchequer each year, money that could otherwise be spent on infrastructure, healthcare, or education. It is a classic case of good intentions leading to difficult financial consequences. For the rice industry, this surplus creates a distorted market. The government's massive presence means that the market is not purely driven by supply and demand. Private players, including millers and traders, find it hard to compete with the government's procurement machine. The government buys so much at MSP that it sets an artificial floor price, says Ramesh Gupta, a third-generation miller from Karnal. This makes it difficult for us to procure paddy at competitive rates, especially when the open market price is lower. This situation creates uncertainty and squeezes the margins of private businesses, forcing them to navigate a landscape where government policy, not just market forces, dictates their profitability and survival. The overflowing granaries have a direct impact on market prices, but not always in the way one might expect. While a surplus should ideally lead to lower prices for consumers, the government's MSP operations keep domestic prices artificially high. This creates a paradox. Millers who buy paddy from the open market often pay a high price, but when they try to sell the milled rice, they face downward pressure. The sheer volume of rice available in the system, including the potential for the government to release its old stock into the market, puts a cap on selling prices. This narrowing gap between their procurement cost and selling price is a constant source of stress for businesses across the country. Their margins are being squeezed from both ends. The export market, once a reliable outlet for India's surplus, is now fraught with challenges. The government, wary of domestic food inflation, has imposed various restrictions, including export duties and minimum export prices on certain varieties of rice. These policies, while aimed at ensuring domestic availability, have made Indian rice more expensive and less competitive in the global arena. Countries like Thailand, Vietnam, and Pakistan are quick to seize this opportunity. They offer their rice at lower prices, capturing market share that was once firmly in India's grasp. Indian exporters find themselves in a difficult position, unable to match the prices of their competitors while also dealing with regulatory uncertainty at home. Adding to the complexity are the ever-present global headwinds. International competition is fiercer than ever. Our competitors are not just matching us on price, but are also improving their quality and marketing strategies. They are signing long-term supply contracts with importing nations, locking in their market share. Furthermore, currency fluctuations add another layer of risk. A stronger rupee can make Indian exports more expensive overnight, eroding profitability. An exporter might agree on a price in dollars, but by the time the payment is received, a change in the exchange rate could mean they get fewer rupees, turning a profitable deal into a loss-making one. These factors make the international rice trade a high-stakes game. These market dynamics have a real-world impact on businesses. Consider the case of an exporter who had a long-standing relationship with a buyer in West Africa. For years, they only bought from us, he laments. But last year, with our government's new tariffs, my price went up by 15%. My buyer had no choice but to switch to a supplier from Thailand. I lost a 10-year-old account. This story is not unique. Many small and medium-sized exporters are struggling to retain their international clients. The combination of high domestic procurement costs, restrictive export policies, and intense global competition is creating a perfect storm for India's rice export community, forcing them to rethink their entire business model. With the export market becoming a treacherous sea, many rice businesses are wisely turning their ships towards the home shore. The Indian domestic market is vast and diverse, offering a wealth of opportunities. Instead of just selling raw white rice, companies are innovating. They are focusing on creating value-added products that cater to the evolving tastes and health consciousness of Indian consumers. This strategic pivot from exporting bulk commodities to building branded products for the domestic market is becoming a key survival strategy. It allows businesses to build a loyal customer base and command better prices, insulating them from the volatility of global trade. One of the most promising new avenues is the production of fortified rice. The government has made it a national priority to combat malnutrition by distributing fortified rice through its social safety net programs, such as the PDS and midday meal schemes. This rice is enriched with essential micronutrients like iron, folic acid, and vitamin B12. This initiative has created a massive, guaranteed market for millers who can invest in the necessary blending technology. It's a win-win situation. The government achieves its public health goals, and rice millers get a stable and profitable new business line. Many are now setting up fortification units within their mills to tap into this growing demand. Another significant opportunity lies in the biofuel sector. India is pushing hard to increase the blending of ethanol with petrol to reduce its oil import bill and combat pollution. Surplus and damaged rice, which is unfit for human consumption, is an excellent feedstock for producing ethanol. The government has been actively encouraging the conversion of this grain into fuel through its ethanol blending program. Several large rice mills and agribusiness companies are now investing in distilleries to convert their surplus stock into ethanol. This not only provides a solution for the excess grain, but also creates an entirely new revenue stream, turning a potential loss into a profitable venture. This shift towards the domestic market is about more than just finding new products. It's about building a brand. Companies are investing in better packaging, marketing, and distribution networks to reach consumers directly. They are selling specialized varieties like black rice, red rice, and other regional specialities that command a premium. By focusing on quality and creating a distinct brand identity, they are moving up the value chain. Instead of being anonymous suppliers in a global commodity market, they are becoming trusted household names in India. This inward focus is not a retreat, but a strategic realignment towards a more stable and profitable future. Despite the emerging opportunities, a persistent and honestly crippling problem plagues the rice industry: the cash flow crunch. The business cycle of a rice miller is, well, long and capital intensive. It all begins with the procurement of paddy from farmers during the harvest season, which, requires a huge upfront investment. This paddy is then stored, milled, and packaged over several months. Only after the final product is sold do millers finally see a return on their investment. This entire process, from buying paddy to receiving payment for the milled rice, can take anywhere from 6 to 9 months. During this period, their working capital is completely locked up in inventory. The problem is made worse by delayed payments from buyers. Whether selling to government agencies or private wholesalers, timely payments are, unfortunately, a rarity. I supply rice to large retail chains, explains a miller from Andhra Pradesh. They operate on a 90-day credit cycle. Sometimes it stretches to 120 days. But I have to pay my farmers and laborers immediately. How am I supposed to manage? This mismatch in payment cycles creates a severe liquidity crisis. Millers are constantly chasing payments while their own bills pile up. This struggle for cash flow is a daily reality that hampers their ability to operate efficiently and plan for growth. Seeking financial help from traditional banks is often another frustrating experience. Banks typically have rigid lending criteria. They require substantial collateral, such as land or property, which, honestly, many small and medium-sized millers may not have. The loan application process is long and cumbersome, filled with paperwork and bureaucratic delays. By the time a loan is approved, the procurement season might already be over. Furthermore, traditional bank loans are not designed for the seasonal nature of the rice business. Millers need a large amount of capital for a few months during procurement, but not for the entire year. A standard term loan just does not offer this kind of flexibility. This lack of accessible and flexible finance is a major bottleneck for the industry. It prevents millers from buying paddy at the right time and at the right price. It also stops them from investing in new machinery, like fortification units or modern silos, that could improve their efficiency and profitability. They are caught in a vicious cycle. They need money to grow their business, but they cannot get the money because their business is not growing fast enough to meet the bank's strict criteria. This financial strain is, without doubt, the single biggest obstacle preventing many otherwise viable rice businesses from reaching their full potential. Into this challenging financial landscape have stepped new-age financial services companies, offering really a breath of fresh air for struggling rice businesses. Firms like Bespoke Financials and others are revolutionizing how credit is extended to the agricultural sector. Unlike traditional banks, they actually understand the unique rhythms and challenges of the rice industry. They've moved away from the one-size-fits-all approach and instead offer customized financial solutions. Their focus is not just on collateral, but on the underlying strength of the business, its inventory, and its receivables. This modern approach is providing a crucial lifeline to millers and exporters who were, honestly, previously underserved by the formal banking system. The key innovation these firms bring is flexibility. They offer products like inventory financing, where the stock of rice itself acts as collateral for a loan. This allows millers to unlock the value of their stored grain and get the working capital they need for daily operations. Another popular product is invoice discounting. A miller who has sold rice on credit can sell their unpaid invoice to the financial company at a small discount. In return, they receive cash immediately, rather than waiting 90 or 120 days for the buyer to pay. This instantly solves the delayed payment problem and injects much-needed liquidity into the business. These solutions are designed to be quick and hassle-free. The application processes are digital, requiring minimal paperwork. Credit decisions are made rapidly, sometimes within just a few days, using technology and data analytics to assess risk. I needed funds to buy a new batch of paddy urgently, recounts a miller who used such a service. My bank said it would take a month. I applied online with one of these new companies, and the money was in my account in 48 hours. It was a game changer. This speed and convenience are exactly what businesses need to seize opportunities in a fast-moving market. Ultimately, the availability of smart, flexible financial solutions is fundamental to the future success of India's rice industry. As the sector navigates the challenges of surplus stocks, export hurdles, and domestic market shifts, having a reliable financial partner is more important than ever. These new age lenders are not just providing capital, they are empowering entrepreneurs to innovate, expand, and compete. They are helping them invest in fortification, build brands, and manage their cash flow effectively. By strengthening the financial foundations of individual businesses, they are contributing to the resilience and growth of India's entire rice bowl, ensuring its continued prosperity in the years